Hello and welcome back to another episode of Vol 411. I'm Cem Karsan of Kai Volatility. Today we're going to talk about the explosion of zero DTE trading. More than 40% of option volume in the last quarter of 2022, with increases happening as we speak, has been happening in the zero DTE options. The main reason for this is because of the underperformance of implied volatility relative to realized volatility. Implied volatility is the measure of the actual pricing of the options because of over-hedging in options leading into the 2022 decline. You've had a significant underperformance of options implied volatility. Realized volatility, however, the actual underlying move of the indexes has actually performed quite well, meaning gamma, the shortest term effect, has been overperforming by a dramatic amount. This has moved people who are looking for hedges into not having exposure to implied volatility, but more exposure to the actual underlying realized volatility. Traders who are generally looking to benefit from this, from the realized volatility itself, are better served by playing in very short-term options. However, sometimes during like the volpocalypse in 2018, they are more implied volatility-centric events. They are events where you have margin calls and positioning is quite poor, and entities need to go buy implied volatility to protect themselves. Under those circumstances, implied volatility performs better. Under current circumstances, that hasn't been the case, and that's what's really driven the zero DTE explosion. Thanks for tuning in for another episode of Vol 411. I'm Cem Karsan with Kai Volatility.